Robschild, thanks for tuning in. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Wednesday, August 28th, 2024. The big news of the day, if you're paying attention to anything going on with financial markets, is NVIDIA earnings. I've been saying ad nauseum at this point that it is inevitable for the valuation of NVIDIA to normalize, for it to really crash. And it has to do with the PE ratio. When you have a company that has a PE ratio of 70, it means that the company is expected to have its earnings double like every year for the next 3 years at least, 4 years, 5 years. That's already priced into today's price. For the earnings to show even a slowdown in the growth of earnings could potentially make this stock collapse. And what happened? Oh my goodness, NVIDIA reports a 122% revenue growth on surging demand for data center chips. This is from CNBC.com. And what's the first key point? NVIDIA reported earnings after the bell that beat Wall Street expectations and provided stronger than expected guidance for the current quarter. Robschild, you must be wrong. That's good news. That means NVIDIA's price is going to go way up from here. I mean, it beat expectations, right? Welp, it wasn't strong enough. As you can see, this is the after hours market. We've been bouncing around all the way between about -2% and -5%, I believe I saw at one point, for the price of NVIDIA. So this is a very large amount of market cap that is being erased. A lot of wealth that people thought that they had is now gone. Granted, we went down over the course of the day 2%, and arguably 3 or 4% is not a ginormous move downwards, but that's not the point. The point is that they came out with good news, and like I said, the good news had to have been like insanely good news in order for the valuation to just not, completely drop here. And it's inevitable for companies that have an enormous amount of growth priced into them for this to eventually happen. And now it's happening. I saw this coming very, very clearly in my crystal ball. I did buy some SOXS with about 2.5% of my portfolio. And so that's obviously doing well in the after hours. I plan to sell it on the open tomorrow. This brings me to a discussion that I've been wanting to talk about on this show, and it has to do with the amount of risk that you're taking as an active investor if you are active investing. And a lot of people will very smartly discuss, don't put your entire portfolio, don't put your entire net worth in something that's like speculative, because if it blows up, if it goes the wrong way on you, you could suffer a loss that is very difficult to recover from. The best advice on that side of it, of being wrong, is know that you can always be wrong, that Mr. Market will always do things that are crazy that you don't expect, and no one can predict the future. No one has a crystal ball except for Robschild. As you know, I'm always right 100% of the time. I kid. On the other side of that, you don't want to take too much risk. Okay, we've covered that part of it, but what about not taking enough risk? If you are very, very confident about a speculative position playing to your favor, you did your homework, you know how this works, you know how it's going to play out, there is such thing as not taking enough risk with your speculations. And this is why it's always important to look at your speculative positions and see, look at them in terms of percentage. Don't look at them in terms of dollars, all right? $1,000 in a $10,000 account is 10% of the account size. That's a very large position. If you were to put that entire position, 10%, into options contracts, and it were to blow up on you and you lose 10% of your entire portfolio size in a short amount of time, that could be really bad. However, if you're dealing with a $1 million portfolio, $1,000 represents only 0.1% of your portfolio, which, if you're invested in the S&P 500, the value of your account is moving much, it's moving in larger amounts than that on a daily basis. And so $1,000 for you is nothing. And, so, you always have to take a look at things in terms of percentage. And if you're on here, if you're going to follow me, if I continue to do this for 10 years, 20 years, if I become successful and you become successful with me, again, never any advice, it's good to always be thinking in terms of percentage. Again, $1,000 for a $10,000 account is a huge amount of money, and $1,000 for a $1 million account is almost nothing. And so, like I'm saying, with a SOXS position, I thought it was, because of the sort of implied volatility of this fund, I figured a 2.5% amount wouldn't, if it went the other way on me, I wouldn't lose hardly anything. But if Nvidia came out with weaker than expected earnings here, and this really collapsed the value of Nvidia, the reward is very much worth, and it would be noticeable, let's say, with a 2.5% position. As it is, they beat expectations, and so it's not as up as much as I hoped it would be, but I'll still take my profits, and I'm happy with the amount that I risked, and I'm going to be happy with this little reward here. In retrospect, I probably would have been okay putting a 5% position into SOXS today, but the point that I was trying to make with this has been made. So yeah, again, as of 5:04 Eastern Daylight Savings Time, we're down 4.5% on Nvidia, and the SOXS is up about 4%. So that's really the main news of the day. We'll go through everything else now. So tomorrow, Thursday, we have our second revision. I talked about this in yesterday's show. Q2 right now says that there was a 2.8% increase of GDP. And the point here is if this is revised lower, this could really be another warning shot, or another canister looking like it could be exploding here. All it takes is a revision of negative 0.1% or negative 0.2%. That would actually be could be fairly influential on markets. And then Friday we have PCE data. Next week we have job openings. The last of this was 8.18 million. It will be very interesting to see what the job opening situation is right now, especially considering the SOM rule has been triggered. Speaking of the SOM rule, Friday unemployment rate, the last of this was 4.3% when it triggered the SOM rule, suggesting that, like I say in our daily reminders, the SOM rule has been triggered. The recession has actually started according to this rule. And then the other daily reminder, 2-year, 10-year Treasury yield curve is still inverted. This is not something to ignore. This isn't just like, oh, everything's fine now. Nope, we're still bleeding. The chance of a deep recession or a depression, in my estimation, are pretty high right here. This never happens. We never have this curve inverted for more than 2 years. The longer we are staying inverted here, the more it seems that the news, other YouTube channels, everyone's just like forgetting about this. This is like this is just nothing. Who cares if the yield curve has This is insane. We're living in insane times. Anyway, I digress. Let's get to the charts. S&P 500 still holding up. My head and shoulders top here that I think is playing out today was just another notch in the belt of this pattern that looks like it's going to go straight down, break this line, and I do think that this is the top of the market here. I think I might add this to my daily reminders that the S&P 500 PE ratio is currently 29.2 without earnings contraction. A lot of these spikes, remember, do involve earnings contraction, which send the PE ratios to spike. We're not in that situation. We're just that much overvalued in the stock market for it to be at 29 right now. Triple Q's, the NASDAQ, also still playing out. Even, I'd say maybe even more obviously in this head and shoulders stopping pattern. It seems to be playing out like clockwork so far. This NVIDIA news is certainly going to have an effect on the NASDAQ itself. It could be a catalyst that sends this plummeting in the near future, in my own estimation. Again, just because the good news wasn't even good enough. I mean, Benjamin Graham said it, not 100 years ago, but a long time ago. All it takes when you have an enormous amount of growth priced into securities is a slowdown. It just has to slow down a little bit for the value to drop. And we're seeing this play out right in front of us. VIX futures term structure still pricing in quite a lot of volatility expected in October. As you can see, it's inverted again, now all the way out to the February contract. It's been bouncing around, going up and down between the January, February, but it's highly elevated for the rest of the curve. So it's been this way for a long time. Markets are expecting a lot of volatility coming in October, as I am. For anyone joining me on TLT, as you may know if you're watching my show, I have more than 50% of my own portfolio in long treasury bonds and leveraged forms of it, including calls, including TMF, including calls on TMF. But you might, if you are been following this with me, you might have been thinking, we're going down now here in TLT. What's going on? This pattern actually gives me comfort. Again, I'm not the biggest expert on patterns, but this one is pretty easy to see in my book. This is what's called a bull flag, and so bond bulls, for now, this is a friendly chart for the bond bulls. And if stocks start to fall apart here as I expect them to, again, this is like a crystal ball thing. I don't know if that's going to happen tomorrow. I don't know if it's going to happen in a week, a month, 2 months, 3 months. I can't imagine it happening in less than 6 months, I'll say, where things become more obviously bearish. Again, this is like crystal ball reading kind of a thing, but if that could be a potential tailwind, in other words, something pushing us forward for the bond market here. The upside down version of this is, of course, the yields. This is the 30-year yield treasury chart. Very similar pattern on the opposite, right? You have your pole going down and you have a flag, a very nice, friendly looking flag here, which for now indicates that the more likely scenario is for yields to continue dropping here once we break out of the little flag pattern here. It should break to the downside, and then it should continue quite a bit, a good amount lower in the very short term. I bring up junk bonds, HYG. Again, I have puts on this for October. Not a huge position, but enough to make it worth it because I think credit spreads are insanely tight here. I do not understand who is buying junk bonds right now. This is just getting out of hand in my estimation. Maybe it's banks, maybe it's institutions that have to lock in slightly higher yields for their clients for some kind of operation, some kind of contract that they made. I don't know. I don't understand it. What I do know is that I wouldn't touch junk bonds with a 40-foot pole right now, and the market seems to adore them. So that's that. Fear and Greed Index from CNN, still in neutral. We kind of got up to 49 almost into greed, and we've been kind of dropping back very recently. Tomorrow, with Nvidia's earnings coming out, I imagine this will continue back down to the fear mode. That is what I see in my crystal ball. A week or two ago, I brought up the US Treasury yield curve and how I saw for the first time the 3-year seeming to be almost completely flat with the 5-year, and since then we've actually gone the other way. The 3-year has risen compared to the 5-year. The 5-year has dropped. However you want to see it, the differential has actually been higher lately on the 3-year, and so that didn't stick yet. And so, like I've been saying in many shows, the way that this yield curve should be playing out, as long as the cuts that are priced into the Fed funds futures play out the way that, you know, that's already priced in, is the front end of the curve will be dropping, and, you know, eventually I believe we will likely see the 3-year drop below the 5-year and then the 2-year drop. I mean, the only other way that this uninverts is for the long end to go up, and we would have to see inflation numbers start to get hotter here and more worry of more hikes here. Again, like, this is inverted. This is not supposed to be inverted. You're supposed to get a higher yield for lending your money for a longer amount of time, because time costs money. We're inverted because the Federal Reserve has it controls the very front end of the curve, and so it's saying, okay, you know, just give us money, you know, overnight, give us money for a month, and we're going to give you this really high rate of return. And the rest of the yield curve that is controlled by, you know, you and me, people and institutions, people that want to, you know, lock in what they think is a fair yield, say, yeah, we're willing to pay and risk more money for a longer period of time with even a lower yield than what's at the front end of the curve, because we don't think the front end of the curve is correct. We think this is going to drop below the current rest of the curve, which includes the 5-year. The 5-year says, what is this, 3.7%? It's predicting right now that the front end of the curve will most definitely be below 3.6% within a reasonable time frame. I bring the chart up today only because it's starting to go more towards that direction. It's starting to flatten out a little bit more than it has been recently, and so it's kind of like this part of the curve, you know, once it starts going further and further, once you see more blue over here where my mouse is, that's the yield curve screaming that the Fed is cutting more surely and more aggressively sooner, which is what I'm fully expecting here. Again, the cutting cycle has started, indicating that the Federal Reserve themselves sees enough of a slowdown that, you know, it's like inflation's not the problem anymore. We're on the other side of this, at least according to them. Some people think that they're cutting early because of elections coming up. I don't think I buy into that narrative. Last chart of the day, KWEB, KWEB. This is a Chinese equity ETF holding things like JD, Alibaba. This is sort of like the Amazon of China, basically. These companies have been massively undervalued compared to their counterparts in the United States, and they are set to take off as long as there's no major, you know, geopolitical event like, you know, certain countries invading certain countries. As long as that doesn't happen, I think this is very dry powder that could potentially, believe it or not, I do believe that this fund could be going up while the U.S. Equities market is going down, and that's just simply taking into consideration just basic valuations, just looking at the valuations of things. I have personally about a 10% of portion of my own portfolio in China. With this drop today, I'll be buying more probably right now in after hours. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.